What's up, everyone? Welcome back to Broke Man Finance. If you're in the market for a undervalued long-term stock that also pays out a decent dividend, then this video is made just for you. Today we're talking about Valero Energy Corporation and why I think it's set to have a nice rebound going into 2021. If you're not aware of who Valero is, well, they're an independent petroleum and ethanol producer that's based out of San Antonio, Texas, and they're currently on the S&P 500 index. They've seen a pretty decent drop this year in 2020 alone, going from around $100 a share to recently around $38 a share, which has resulted in a 61% decrease for the year alone. One of the obvious reasons we all know is because of COVID-19 pretty much decimated the travel industry for 2020 alone. I mean, we saw people being shut down, forced at their home for 2 weeks. After that, corporations was allowing people to work from home or remote locations, or they wasn't traveling as much. Vacations was canceled across the world for the most part. And the airline industry, which is a huge fuel consumer, pretty much just sat on the tarmac at the airports and collected dust. We all know that the result of this was billions and billions of fuel not being used, which also translates into billions of dollars lost for fuel companies, and Valero was no exception. In Q3 alone, Valero reported a loss of over $464 million because of this result. Everyone gets it that because of COVID-19 and the shutdowns, the energy sector, primarily the fuel sector like Valero or BP or Exxon, took a major hit, and quarter losses were expected. Obviously they wasn't preferred, but everyone knew that if people wasn't traveling, they wasn't buying fuel. Each company was going to show a major loss of revenue on all these quarters as we go into 2021. But let's change gears a little bit, and I'm going to tell you why I think Valero is set for a nice rebound going into 2021 and the years after, barring another COVID-19 attack or shutdown on the country doesn't happen. So prior to 2019, Valero was showing some pretty decent growth for a company. In a 10-year span, they was averaging around 100% growth, which breaks it down to about 10% growth each year. But here's the thing about Valero, they tend to get overlooked. They are a huge company, one of the largest refineries in the United States, and have over 15 refineries across the world. But let's be honest, they are kind of like the stepchild of the fuel industry in a way, because people, when they think of fuel, when they think of energy stocks, they think of the Exxon, they think of Marathon, and they think of BP. So they get overlooked, or they kind of get kicked down in my mind on far as like these sexy stocks or these big energy stocks when we're talking about market investing into the energy sector. Currently they're paying out a dividend yield of over 10%, which is crazy right now, which has resulted this past quarter in almost $1 per share. Think of it this way: if you bought one share of Valero right now at around $38 a share, at the end of the year, you would have roughly just shy of $4. At the end of a 10-year period, just in dividends alone, if they didn't cut the dividend or reduce the dividend payout, just in dividends alone, you would break even on your investment, not incorporating the appreciation or the capital gains if that share went from $38 or $50 a share to $100 a share during that 10-year period. You get the appreciation of earning, the $70 to $50 a share in value, plus the dividends that paid out during that time. In doing our due diligence for viewers on videos like these, we have to state that the energy sector has been very volatile over the past couple of years. We see fuel prices go up and down, the cost of crude oil per barrel goes up and down. So these companies do take a hit, and it's almost like an emotional roller coaster when you're looking at the price of BP or Valero. They're all the same, and they take a hit and they take these wild rides at times. However, the thing I like about Valero is even though their stock price has been on this wild ride, they've been very consistent over the past several years paying out their dividend. They haven't really cut or reduced their dividend during this time, which shows me that it gives me kind of a warm and fuzzy feeling as an investor if I'm invested into this company just as a dividend payout alone, not counting the appreciation of the stock as it goes up or the depreciation as it goes down. Since 1999, they've shown a steady payout until now. Other than 2010 when they cut their dividend slightly, they've been pretty consistent as far as growing as well as paying out that dividend to investors. Earlier I mentioned that Valero kind of gets overlooked by the larger companies. but they are in fact a huge company, and they're recognized as an international company with owning over 14 refineries across the world, the majority of those being the United States, but they also have those companies in South America and Europe as well. They're also very, very active in ethanol production and have over 14 refineries in the Midwest states that focuses on ethanol production, which right now their capacity is about 1.7 billion gallons of ethanol each and every day. So here's one of the things I like as an investor is their financials. Now obviously we're not breaking down 30-40 minutes of financials and balance sheets and cash flow. We could do that on another video, but this kind of gives you a snapshot of what I'm looking into as an investor. At the end of Q3, they reported to have over $10 billion of debt. Now, some people, that may be a lot of money, but to a company such as Valero, that is not a lot of money at all. Every company is going to have some level of debt. It just depends on how much free cash flow you're coming in to combat that debt or continue to pay off that debt. As you expand or improve your corporation, you're going to borrow money to kind of keep that cash on hand to be liquid. Prime example for events like COVID-19 or 2020, where you're going to take a massive hit as far as your income and your revenue. But at the same time, they report to have over $10 billion of cash on hand, and their total assets right now is self-reporting at over $53 billion of total assets. So if you look at those numbers, and again, this isn't a deep dive analysis of those numbers, they're in a pretty good shape financially wise to, even if 2020 was a terrible year or worse than 2019, they have the money to survive going to another year. However, as the travel industry is coming back, I think they're in a good position. But I'm not the only guy that likes this company. If you go to Morningstar, Seeking Alpha, there are multiple articles of analysts saying, hey, this company is undervalued. You're like, hello everyone. This is a stock that you may want to look at, you may want to buy into, because it is poised to set for a nice return back to where it was trading. Now, obviously these analysts aren't saying it's going to go back to $100 in the next 6 months to a year, but over the next year or two, a realistic idea as far as the stock price or the target stock price is around $60 to $70, when right now it was trading around $38 a share. So as for me and my investment strategy, I'm listing myself as a strong buy on this. I want to try to buy as much as I can to diversify my portfolio and add to it on this undervalued stock. Because if it's set for return in 2021, people are poised to make a lot of money or have a strong percentage growth in their portfolio, even if it doesn't go crazy high in 2021, going in the next 4 to 5 years. Because again, I'm listing this as a long-term investment, and a lot of the analysts are listing this as a long-term investment. But buying in right now at $38 a share, or even below $50 a share, it is shown that pre-2019 levels, it was comfortable, and investors were comfortable with it trading at over $100 a share, in addition to that incredible dividend payout. I think it's a no-brainer. But as always, just don't take my advice for it. If you want some more research, do your own research, or reach out to a certified financial advisor or planner and let them kind of walk you through the steps on what to collectively y'all think that you should do with your money. As always, guys, thanks for watching the video. If you haven't already done so, hit that like button and or subscribe button, and let me know in the comment sections what you think about this company or what you think about the video. And we'll see you on the next video.